I'm Rajul Assad and I love real estate. Hello and welcome to my channel. In this episode, episode 15, we are discussing the Fed raising interest rate and why this matters. Let's get into it. Hey everyone, so hopefully everyone watching this by now is well aware that the Federal Reserve, has raised the interest rate as they had basically telegraphed to everyone another 3/4 of a basis point. So for those of you guys who don't know, the way the basis points work is 100 basis points is basically 1%. So 0.75 basis point is 0.75%. Now, some of you are probably asking, what exactly is the Fed? And let's break this down. So if we go to their main website here, and board governors of Federal Reserve System about the Fed. It says the Federal Reserve System is the central bank of the United States. It performs 5 general functions to promote the effective operation of U.S. economy and more generally the public interest, the Federal Reserve. 1, conducts the nation's monetary policy to promote maximum employment, stable prices, moderate long-term interest rates in the U.S. economy. 2, promotes the stability of the financial system and seeks to minimize and contain systemic risk through active monitoring, engagement in the U.S. and abroad, promotes the safety and soundness of individual financial institutions, and monitors their impact on the financial system as a whole, fosters payment and settlement systems, safety and efficiency through services to the banking industry and the U.S. government that facilitate U.S. dollar transactions and payments, promotes consumer protection and community development through consumer-focused supervision and examination, research and analysis of emerging consumer issues and trends, community economic development activities, and administration of consumer laws and regulations. Man, I don't know about you guys, that was boring. Did anyone notice something was missing from the 5 general functions that they're saying? Some of you guys out there might have guessed it. If you guessed inflation, you were right. Notice how it doesn't say anything about inflation. It does say about keeping rates in a position so they can maximize employment. So it's pretty curious that on their own website, they don't mention inflation. However, that is one of the things that the Fed chair always says that they're looking to control. All right, so the Fed essentially is the central bank of the United States. It's not part of the government per se, but the chair, the chair of the Fed is picked by the president. So it's kind of 1 foot inside the government, 1 foot outside the government. But once the president picks the Fed chair, theoretically, the Fed chair is not supposed to be influenced or take orders for the president. The Fed is supposed to have complete autonomy, although human beings are human beings and people are people. Obviously, sometimes, the Fed tries to work in a way that doesn't hurt the president. I mean, this has happened a while, several times. So, and for you guys, let's not go down the road of conspiracy theories or whatever. So anyway, that's basically the Fed. Now, what the Federal Reserve interest rate is the rate that banks use to lend each other money on an overnight basis. Now, you're probably wondering, why would the banks lend money to each other and why would they charge interest overnight? So the way the banks work, and some of you might find this interesting, when a bank has, let's say, $1 billion in deposits, it actually does not have $1 billion in cash sitting someplace. Most of that money is literally lent out to consumers in the form of mortgages, car loans, credit cards, home equity lines of credit, etc., etc., etc. Now, they're allowed to do this, but they have to keep a certain amount at all times, or actually I say at all times, but I think as of when they actually close and they go through this whole thing of balancing books at the end of the day, they have to have a minimum reserve. if they find that they fall short, what they could then do, or they're going to fall short, what they could then do is reach out to one of their banks that are friendly to them, and then they can basically borrow whatever they're short and hold on to that. Then once the next day comes over, they return the money plus interest, and they conduct business as usual. All right, so that's the federal funds rate. So the prime rate, which is what all of us are concerned about, is the basic rate that they use. It's tied to the federal funds rate. It's like, I think it's like a point higher than the federal funds rate, and that's the starting point for them charging credit, etc., etc. So as of right now, and here's that nice news here we got on CNBC. Fed just raised interest rates by another 0.75. And this is a pretty good article on CNBC. And now it's going to discuss what are the things that are going to affect you and me. All right. So right off the bat, and I know some of you guys were thinking, hey, like federal funds rate, I'm not looking to buy a house anytime soon. How does this affect me? Well, everyone has credit cards, right? So what you're probably going to find is with the interest rates raising, and you know what? A lot of you guys that are out there, if you see that this happens, you could actually call up your credit card and challenge it. But most, if not all, the credit cards are probably going to raise your interest rates. I also do know for a fact that if that does happen, you can actually challenge that. They may not drop it. Maybe if you threaten to cancel the card, they might drop it, but who knows? At least you tried, right? So next one would be car loans. So if you guys that are out there on the market for a new car, you can expect to pay more now than you did, I mean, as of yesterday, right? I mean, they just raised the rate, or even as of a couple months ago, or when was, I forget the last time they raised it, but as of that time, I mean, interest rates are up basically 1.5% at this point. And then obviously adjustable rate mortgage. Unfortunately, our students that, you know, kind of had a tough time last couple of years with COVID and the lockdowns, now their student loans are going to be more. And then, of course, there are other loans like home equity lines of credit, etc. You can expect all those to go up as well. So I just want you guys to understand, it's not just the cost of buying a new home that's going to be more. There are these other factors that are coming in. And for those that you're wondering, why are they going to make my loan payments, credit cards more expensive? What they're trying to do is to tackle inflation. And the way they're trying to do this is to discourage people from spending. And the way that they do that is by having the cost of you to spend to go up. So obviously a lot of people, you know, like to pay for things on the credit card because they know, well, I could just make a easy payment or pay some of it off now and just pay in installments. And obviously for some people, when interest rates go up, they're going to be maybe less likely to, you know, buy something that they can't necessarily pay in cash right now or pay off right away on if they buy it on their credit card. Maybe instead of going out 3-4 times a week for a nice dinner, maybe it's going to get cut back to 1 or 2 times a week. So it all depends on everyone's individual budgets and individual lifestyles. Now, let's go back up to what they were talking about. Oh, anyway, mortgages, etc. What this means, and I'll start off with the investors. What it means is that when you're looking at deals, because the interest rate is higher now, the cash flow is going to be less because you're going to have to spend, if you're not buying cash, you're going to have to spend more on financing, which inevitably means that deals that might have been cash flowing a few months ago are not going to cash flow now, which essentially means that investors will have to lower their prices to get in line with the higher interest rates, or they're just not going to sell. So that's definitely up in the air. And then there's also, you know, the demand, and we're going to see how much of an effect this is actually going to have on the demand when it comes to investors. As far as homeowners, we've definitely seen the market starting to slow, starting to cool, and buyers are getting pickier. Um, Prior to the last two interest rate raises, buyers were essentially, since, I mean, a house would go on the market, they would get 30 written offers within a few days. So those buyers that really wanted the house, to make their offers competitive, they were paying above asking price. And then to make it more, their offer more attractive for other people, they would waive all contingencies. They would waive the inspection contingency, the appraisal contingency, the finance contingency. Now, what we're seeing is that buyers are putting, first of all, there's less offers putting in. Instead of 30, maybe now they're getting 10. And instead of people offering above asking, maybe they're just getting a little over asking or at asking. And more buyers are no longer waiving contingencies. They're being a little bit more cautious. So will that cause major reductions in price? I mean, it's anyone's guess. So far, what I'm seeing out there is I'm seeing well, I guess the good news is I'm seeing price reductions, which that definitely wasn't the case, with the exception of houses that were just pie in the sky. Their asking price was literally just way beyond what the market was. For those houses that weren't exactly priced correctly, but somewhat in line with what had been sold. And just to give you guys a little bit of information, when you are pricing a property that is going, that you're going to put on the market for sale, you want to price it taking into account the market that you're in. What do I mean by that? If you're in a market that the home prices are going up, and you could look at the data and the numbers and figure out where that is. If it's going up 1 or 2% every few months, or 5% every few months, you can then price your home. Well, first you want to determine what the market price is currently, keeping in mind that when you run comps, which stands for comparables, you're looking at it's lagging. It's not at the current, because obviously by the time you see it sold, even if it sold yesterday, even if it was all cash, it was under contract for at least a couple weeks. And then most people finance, which usually takes around 30 days for all that to be done. And they usually close around maybe 32, 33 days after they sign the contract. So by the time you see the price, typically speaking, about a month has already gone by. So with that being said, when you're in a market that is going up, you want to price it just a little bit more than what the market is currently. Now, conversely, if you're in a market where demand is starting to go down, to be competitive, you don't price it at market prices, keeping in mind that that information you have is at least 30 days old at best. So you're going to want to look and see, well, okay, I'm seeing price reductions by, for the homes that were properly priced appropriately, I'm seeing price reductions of 5-10%. Depending on your needs, hey, I want to get this house sold as quickly as possible, and I want to get the most money. And what a lot of people don't realize is, generally speaking, the faster your house sells is when you're going to get the most money. So with that being said, in a market where demand is starting to drop, you want to price it with that drop in mind. This will vary based upon your individual market. In some places it'll be maybe 2-3%, some places 10%, who knows, some places maybe even 20%. So you definitely want to take that into account. Now that's what's going on. Now on the developer builder side, this is where it gets kind of interesting and a little troublesome, a little worrying here, because as everyone knows, one of the big reasons that we had such strong demand in the real estate market is because of low inventory. Well, what does rising interest rates mean for the guys that are actually building the new inventory. It means that their costs have gone up now, which inevitably means some of these projects are going to get stalled, which could mean that another guy could potentially come in and maybe get it at a price that that person can continue the project. But it's tough, and then we'll see how that's going to turn out. And then what? With the developers, the builders. Yeah, with interest rate. Actually, that's what I was going to say. So with a lot of projects potentially getting stalled or canceled, this is going to add. Well, I say add, but in reality, it's going to subtract from inventory. And then another thing a lot of people don't understand is that there are a lot of people that are not going to be able to put their house on the market, or may even take their house off the market, because they feel that if I sell the house now, I am not going to be able to get the house they want because the interest rates are so high. In other words, what I'm saying is you have people out there with homes that have interest rates in the 3%, and now it's looking like they're going to be paying, if they go out and get a new home, they're going to pay 6.88%, assuming they have average or fairly decent credit on a new mortgage. That essentially means that they could essentially get a house that's close to half of what their current house is worth and then pay the same. So for a lot of people, that's not really going to make sense. So that's actually going to contribute to less inventory. Essentially what the Fed is trying to do, they're trying to play a very they're trying to play a balancing game, and it's almost literally like two ends of a seesaw, and you're trying to get to that perfect balance. And hopefully the Fed can get that. It's definitely not easy to do, because like I said, on the one hand, they're taking a lot of demand away, but then on the other hand, they're also constraining supply in the real estate market. So obviously everyone's watching, very curious to see how that turns out. But now, actually, let's take a look for you guys, and for you guys that don't understand the difference in that interest rates can play. Let's take a look here at a mortgage calculator that right here. So let's see here. Oh, so this is just telling me the rates. Actually, I had this taken care of. Let's just move this over here. All right. So right now, mortgage rates are at 6.88 on 300K, 20% down payment. On someone with a credit score from 700 to 719, which is the average credit score. Now let's take a look at a mortgage calculator. So I'm going to use 375,000, which is the median price of a home. And just to keep the math simple, I'm going to use 6.75. Interest rate. So as we can see, your monthly payment is going to be $24.32. Now, let's take that down to 6%, which drops it down to 2,248, which is about $175 less. Now, let's take into account not just the interest rate that just happened, but the one from before, which would bring this down to 5.25, and that's 2071, which is 352. So as you guys can see, 171, some people might say, well, it's not too much, it's not too bad. Some people might say, well, I could still get a home. I might just have to, I don't know, cut my cable or maybe eat out once or twice a week less. But you can see how 352, now we're starting to get into a more significant amount, which could definitely kill some deals here, or maybe have people pause, especially if they're a little concerned about their income situation for whatever reason. But it's not all bad news. According to time.com, your savings account could go up to 2% interest that the bank's going to give you, which I believe most people now are getting 1%. So 2% basically doubles your savings account. So it's not all bad. And I know most of you guys are saying, well, 2%, I mean, yeah. So, even if you had $1 million, that's, it's still $20,000 a year. Some people might be okay with that. It's still pretty low. But it's not all bad. With these rising interest rates, the US dollar, at least for the first time I can remember, is actually worth more now than the euro and the British pound. So that means that for you guys that like to travel internationally or go on vacation, it means that the dollar's purchasing power has gone up. So hey, maybe more people get out there. Maybe more people go on vacations to Europe. More people going to South America, Canada. So it's not all bad. But anyway, guys, I hope you found this video useful and informative. And I'm going to keep watching on what's going on with the Fed. Oh, that's another thing too, guys. Like, Fed's not even done yet. The Fed has raised rates, I believe, 4 times this year. And we're not done. If I remember correctly, I think they said they're going to raise it another 2 times this year. So hang on to your hats, guys, because yeah, I see a rocky road ahead. So, but anyway, guys, I'm Roger. If you got something out of this video, please like, comment, and subscribe. All comments are welcome. I read them all, and I try to respond to every last one. But anyway, I'm Roger, and I will see you guys soon. Bye.